indicating growing buying interest. As demand strengthens, the price expansion also becomes more pronounced. Now, structure number 2. Volume is also increasing here, suggesting heightened buyer activity. However, there's a critical detail. The size of the bullish candle is smaller than the previous day's move. Moving on to structure number 3. On the first day, we saw heavy volume but almost no price progression. It is a sign of absorption or distribution. On the second day, volume contracts, but the price move becomes much larger. Finally, structure number 4. On the second day, we see a strong spike followed by a pullback, forming a prominent upper shadow, wick, while volume declines. What potential risk does this introduce? A long upper wick combined with lower volume often signals selling into strength or fading momentum. Given the evolution of these two-day patterns, if you had to reassess your choice now, which structure would you favor for a potential entry? Type in your answer in the chat. 1, 1, 2, 3, 4. Given the evolution of these two-day patterns, if you had to reassess your choice now, which structure would you favor for a potential entry? Type in your answer in the chat. 1, 2, 3, 4. As I mentioned earlier, today's session will involve simulated analysis of candlestick structures. How will we approach this? We'll start by ciphering more complex multi-candle formations from these simple examples. Through this step-by-step process, you'll gain a deeper understanding of the dynamic relationship between price action and volume. Now again, based on the current developments, which setup do you believe has the strongest probability of continuing higher? Type your answer in the chat. Remember your answers. Let's continue with the discussion. Let's break it down carefully. In this volume-price relationship analysis, if we analyze structure number 1, starting with low volume, modest price rise. As volume increases, the price rise widens. This is called a volume-price expansion structure. Volume and price rise together. Structure number 2, analysis. Volume keeps rising. However, price movement slows, it stalls. This is called a volume expansion with price stagnation, a bearish divergence warning. Now a question for everyone. Does the volume-price relationship here match or diverge? Type 1 for match, 2 for divergence. Structure number 3, analysis. Initially, high volume, low price movement, heavy divergence. Next day, volume shrinks, price surges. This indicates reduced divergence, a positive bullish sign. Is divergence decreasing a good thing or bad thing? Type good if you think it's positive, bad if negative. Structure number 4, analysis. Spike followed by pullback, visible upper wick. Decrease in volume. Could this be a potential bull trap? Think carefully. Many of you may have experienced situations where you buy and immediately the price falls. You sell and immediately the price rallies. The root cause behind these frustrations is often a lack of fundamental understanding of volume price behavior. That's why today's live session is designed to strengthen your technical foundation, teach you how to analyze structures properly, help you decide whether to stop loss or continue holding in the future. Now let me ask if are there any participants here attending for their first time. If you are new, please type 9 in the chat so that we can see whether today's session has more or new participants. For those who haven't yet, make sure to click that subscribe button. You wouldn't want to miss this discussion about advanced volume price structures. Mastering these complex combinations is critical to succeeding in real-world trading. Let's quickly summarize the 4 major volume price structures we introduced earlier. Structure 1, volume price expansion structure. This is something that even beginner can grasp easily. Structure 2, volume expansion with price stagnation. This often signals slight bearish divergence. Structure 3, shrinking volume acceleration structure, indicates decreasing divergence. If this appears at low price levels, it often forecasts a bullish breakout. Structure 4, today's focus, a slightly more challenging concept. We will analyze whether there is a potential bull trap in this case. Does the volume-price relationship match? If you think it matches, type 1. If not, type 2. For structure 4, it can be divided into two possible scenarios. Scenario 1, relative matching between volume and price. Scenario 2, relative divergence between volume and price. Here's the logic. A large volume at the bottom typically corresponds to a large bullish candle. As volume decreases, the price increase should also diminish proportionally. In this case, the volume-price relationship is relatively matching. For those who typed 2 earlier, let's explain it more clearly. On day 1, volume is 10 million, price rises 8 points. On day 2, volume drops to 5 million, price rises only 4 points. This proportionality means the volume-price relationship is. Looking at structure number 1, we notice that both volume and price are increasing, signaling strong upward momentum.